There you go.
So, hi guys.
Hello.
We are back after a seemed like forever vacation for the holidays. Hope everybody had a wonderful Christmas and a happy New Year. We're gonna just kind of talk informally here, give people a little bit of time to chime in. We're gonna be talking about the markets, as far as real estate markets, equity markets, the economic market. As you can see on the information that I put for the video, we are not financial advisors or investment brokers or anything like that. So we are just watching the market. We are realtors that are watching the market.
We pay attention to those trends.
We do. 2008, I was just getting in the job section and learning how to become an adult when the market crashed last time. And I kind of
lessons to learn. Right?
I kind of grew up very, picking, and every little penny mattered. So when we're looking at the market, we want to understand what's going on. And I didn't know then, what was it? 10 years ago, 11 years ago now. It was just picking up, and now I'm glad. The only mistake I made in real estate is I didn't get in sooner. But it was a hard lesson for me to learn as far as what happened in 2008 and afterwards. But I also didn't own a home then. Mark, what happened around 2008? What was your take on it?
Wow, it was a financial meltdown. When Lehman Brothers declared bankruptcy, that was a major deal. Lehman Brothers had been around for 100 years or more, I think. Mm-hmm. And when they filed for bankruptcy, when they basically started to go under, it was a scary time for the financial markets. The Fed chairman at the time said, we need to do something quick. We need to shore things up. And they did this, that eventually led to quantitative easing, or QE1 and 2. To try to restart the economy. But there were a lot of people who were out of work.
A lot of jobs lost. I mean, I basically got laid off my job. I was working for free for a while. And a lot of people who know me know that I had a previous career. I worked, I was an exotic animal handler, and I worked at the Gulf Breeze Zoo. But, I didn't get paid for a while. And we lived off of donations from places like Publix and things like that. The market's very different now, though, and we were in a bull market. Once the Fed dropped, the rates really low, because they had to. I mean, nobody had any buying power, much less the jobs were such a scarce. So it was a very slow incline. But we've been in a bull market for a long time now.
Over 10 years.
Over 10 years, yeah. It's been a pretty big bull market, I would say. A lot of people that are observing the market, they told me that we should have had a market correction back around 2012, 13, and 14. And that didn't really happen. We just kept bulldozing. We were that bull market. And from what I'm getting now is that we could be going back into a bear market. But what are we really looking at? And that's what we're here to discuss, and what me and Mark are very interested in. Mark has a lot of interest in stocks and bonds. And
I do. I follow the markets. I follow the equity and the bond markets, and I also follow, of course, real estate very closely.
Yeah.
And there's just been, I think it's safe to say that there's been a lot of volatility in the market in the last few months, and it's gotten people concerned. What's going to happen with the equity markets? What's going to happen with the inverse yield curve? What's going to happen with real estate? Mortgage rates? Are prices going to go down? Are they going to continue to rise? What are we going to see likely in the future? So we've made some observations. We've done some research, and we've come up with some thoughts on that.
Yeah, we just kind of want to touch on some points. We don't want to scare anybody. We don't want you guys to be scared or freak out or anything like that. We don't think that things are going to be crashing overnight or anything like that. But overall, our economy is really strong right now. Our jobs, our unemployment is
at a 50-year low.
50-year low. Yeah. So when it comes to buying power, and for sellers, for you to sell your house, someone's got to be able to pay the mortgage whenever you hand it over. Mm-hmm. And that's important. It's important for buyers who want to buy homes, and it's important for sellers that want to sell their homes. So what are we really looking at here? as of right now, I mean, I took a look at the market today and it's up. So over the holidays, we had like a roller coaster going on. I think the S&P dropped over 500 points. We did not get that Santa Claus rally that everybody was expecting. And obviously we are still in a government shutdown. So there's a lot going on right now. And I know a lot of people might not realize or are not able to analyze the whole situation.
Mm-hmm.
So that's what we're kind of sitting here doing. So if anyone has any questions or comments or anything that you'd like to say or add, and we can do a live open discussion. We're going to be going on a little bit longer today because of this, because it's such a big and broad topic to talk about. So just to start, what we saw before we went on vacation or Christmas break, we saw the market take a big dip, right? You want to talk about that a little bit?
I mean,
it was a big dip.
I mean, one day it was down 500 points, another day it was down 600, 700 points. I mean, over the last, I think December was like one of the worst months in years.
Yes, since 2008.
I mean, the Dow went down like, several thousand points cumulatively. It's my understanding, and people were rightly so concerned. I mean, 401ks, where's my retirement money what's it gonna do? How's it gonna impact the rate at which I need to save money for retirement? It's got broad implications.
It makes buyers in the market really scared, and like the storm clouds brewing, and it scares a lot of people off. And I will say though that China trade deals, the government shutdown, that affects our economy. But what affects our economy more than anything is what the Fed has been up to.
That's true.
I'm not a fan of the Fed. They have a purpose.
They do.
They do not have to answer to any single one of us Americans. They are privately owned.
And just as importantly, they don't have to answer to the president.
They don't have to answer. No, they don't.
They're apolitical. So if the president says, I don't like what you're doing, Jerome Powell, he's the Fed chairman, and try to get you fired,
which they did have a meeting. They held a meeting in Washington December 18th and 19th. So right before Christmas vacation, right before everything happened. And I just want to point out that the Fed has raised the rates eight times in 2 years.
Yeah.
That's a problem. That's a big problem because it shocks the market. And I think, honestly, that's what happened. Combined with China trade deals and renegotiating trade deals, which I think we're looking at coming to somewhat better of an agreement.
My understanding,
from Bloomberg, what I've read on Bloomberg and some other sources online is that we're finally starting to reach some better agreements that are going to benefit both of us countries. China is just dependent on us as we are on them. Our economies are so interlocked, so we have to work together.
Absolutely.
We can't say that we're not feeling it. Obviously, the stock market has shown that we're feeling it. And we know that China's economy is feeling it as well. So that is kind of driven more successful talks. And the market is starting to reflect that people are still confident in new deals that can be made. So we saw that iPhones and they took a big hit.
They did. Using demand from China is actually down quite a bit. And that is affecting China's economy, it's affecting our economy. I mean, everything's connected now globally. I think that started back in the Clinton era.
Yeah.
I was trying to connect everything to a global economy. So if China slows down their growth, we're going to be impacted by that and vice versa.
Right. And what we've seen with this bull market, especially in real estate, we have seen, and since I came in and got my license, before I actually got my license, I was doing foreclosures and flips. I was doing joint ventures and assignments. So I was working with a lot of foreclosures from the crash in 2008 still. From the time I got my license and from the time that I started working with those kind of flips and real estate investments, we're talking 20 to 30, even $40,000 higher in home values.
Yeah.
So we're talking in a period of 4 years that I've been in the real estate business, that's how much properties have tripled or doubled in value And honestly, it's great for sellers, and it has been a bull seller's market. Are we coming to an end of that? I don't know. I mean, I still feel like it's a really good time to sell your house.
So I would concur. All you sellers out there, potential sellers, prospects, if you will, you are definitely, the market is definitely working in your favor. It has been for a while now.
Yeah.
The real question is, what's going to happen in the future? Are rates going to level off? Or I should say, are prices going to level off? Are they going to increase? Or are they going to start to decline? I had an opportunity about a week and a half ago to watch CNBC for 90 minutes or so, maybe 2 hours. And I watched 3 very, very bright people. One's the current Fed chairman. His name is, I should know this, okay, it's Jerome Powell, also known as Jay. And also Janet Yellen, who's the former Fed chairman, and Ben Bernanke. And they talked about basically that the central bank isn't on a fixed path to push benchmark rates higher. So this translates into mortgage.
They changed their path a little bit, because when I, not even 4 or 6 months ago, when I was really like wondering, oh my God, when is this hike in home value is going to stop? Because it's great for sellers, but buyers lose buying power. When interest rates are going up and home values and everything else is skyrocketing, you have a smaller buyer pool. Less people that are going to be able to buy your house.
Sure.
That hurts the seller's market. So I think that the Fed realized what they were doing. With everything is kind of unstable as it is right now, that continuing with rate hikes is probably not the smartest idea. I've heard it was 4 hikes were set for 2019. Now I've heard one hike.
Well, what they're basically saying, what I got out of the discussion was they're going to continuously reevaluate where we're at as time progresses. And they're going to continue to look at current market data before they make a well-informed decision about whether or not to raise rates or leave them alone.
Yeah.
But due to the fact that inflation is very mild, it's right around 2% right now, and the economy is strong. It's not overheated, but it's very strong. They're going to take a judicious approach, and they're going to probably step back, and I don't see them raising short-term interest rates in the near future. I just don't see it.
I hope not, because don't get me wrong, I want a market correction. I want to be able to have sellers sell their house fast when they need to move. I want to be able to have buyers that can get approved for loans, because if the job market is good and if they have a buying power, then they can buy. But if the interest rates keep going up, cost of living keeps going up, everything keeps inflating, and that just decreases your buyers and it hurts everybody all around. So what's good about it is the Fed is going to hopefully either retract some of these hikes. They might even lower some of them. But I think they're going to try to push them a little bit more. I feel like they are, because they know the economy is strong. And if we do get good trade deals with China, and once the government does come to some sort of agreement, we've got to move forward. We've got to keep going. Last time we want a stagflation or anything like that. So right now, I don't understand they have balance sheets and stuff like that. But I will say, and it's pretty obvious if you look through history, the Federal Reserve has caused every major economic crash. They influence and manipulate the interest rates, and by doing that, they cause a ripple effect within the economy.
And what they're trying to do, I guess, by raising rates, for example, would be they look at certain sectors like the real estate market. And they're saying if we target that and try to pull back the reins a little bit on that, it's going to prevent the overall economy from overheating, making things worse.
Yeah.
So they're doing that deliberately, okay? But now what they're saying is, we already mentioned unemployment is at a 50-year low. The economy is strong. It's not superheated or overheated. So they like where inflation's at. It's close to their target of 2%. So I think they're backing off from the initial push that we heard about a lot about last year, where they wanted to continue to raise interest rates.
Yeah, I mean, it was set for 4 hikes in 2019, and they have completely backed off to 1 so far. And some investors that I'm talking to are saying, well, whatever, even if they go up, they're eventually going to have to go back if everything starts going down. So,
I think the point of all this discussion regarding rates is that this translates, of course, into mortgage rates. And the higher the mortgage rate you pay, okay, the less affordable it is to purchase a home, okay, on a monthly basis. So what we're saying is it seems that the trajectory of prices, home prices, in this market, in this area, is going at it continues to rise, but not at a rate that's alarming. And we're not seeing any of the fundamental problems that appeared back in 05, 06, 07. We're not seeing that in this market at all.
Well, I've heard too, as well, is that a lot of what had to do with that market is there was a lot of things that were inflated, social media, right. Things that had no real value within the market, nothing concrete value. It's just, what do you call it, intangible? Mm-hmm. Intangible? I mean, it's just social media. It's not, has no physical real value. So it's interesting to see that when things like that prop up the market and then people realize, or within the market, it realizes this means nothing. Yeah, of course you're going to see a drop. You're going to see a drop. Right. So there is so much going on, and a lot of what's in the market right now just seems like kind of crazy. It just seems like
it does.
People are kind of just running in circles here, not really figuring out what's going on. So that's why I just like to kind of talk about it and really kind of, get grounded as real estate agents, because people ask me all the time, what's going on? What's going on? So
real estate is still a great investment, especially in this market, in the right in the bar area. Very high value for what you get. I remember a while back, not too long ago, maybe in the last 4 or 5 months, looking at a vacant lot on the Bar Beach, and I believe it was 90-foot Gulf front, and the price was somewhere in the vicinity between $700,000 and $800,000 for this lot, probably about a quarter acre or so. To someone who's not familiar with this market, they may say, "Wow, that's a lot of money." Mm-hmm. Well, if you take the same lot and put it down on 38, for example, which is east of here, probably 80 miles, 100 mm-hmm. miles, that same lot will be $2 to $3 million. So the value you get here is really incredible, and I've heard people describe it as one of the best values in all of Florida.
As far as values go, no values have stopped. If anything, if things are still appraising, what we're pulling comps for, I haven't had any major decline or drops in values, and if we do, it's probably going to be towards the end of 1920. But I'm hoping to have that. Like I said, we want a market correction. We want buyers to be able to afford. If we keep those prices from skyrocketing, the better it benefits you. So sometimes these market dips are actually a good thing. Yeah. It actually is kind of, it helps stabilize the whole market altogether. But what I want to point out is that a lot of investors that put a lot of their money into stocks, when the stock market gets a little crazy, guess what they put their money into? They go into real estate. Right. Why do they go into real estate? Well, real estate just overall, it holds its value. Anytime you have a market where people can't buy, what are they doing? What are they doing? They're renting, aren't they?
They are.
So if you have an accumulation of rental properties during an economic dip or a recession, you're going to be on top because you're going to have some cash flow during that downtime. So that's what investors, when it comes to last, kind of like what they're really going to put their money into when the stock market's not doing so good, they're going to put it in real estate. So
some will put it in cash or treasury bills, but really better investment vehicle, I think, is real estate.
I'm glad you brought up cash because I was looking at Bloomberg's market update on the dollar, and the dollar has lost some buying power. Mm-hmm. So the dollar has dipped a little bit, and guess what's up?
Real estate.
Real estate and gold.
Yeah, that's right.
Real estate and gold. So gold is an investment. Gold and silver is precious metals. I prefer those over the stock market any day with real estate and gold and silver. You just can't go wrong. So what's important to know is that, and understand, and I have to kind of sit back and realize myself, is that buyers are going to buy if they have to. They'll find a way. Sellers are going to sell if they have to. They're going to find a way. People have got to live. They need homes. Their business, all of that revolves around their livelihoods. So at the end of the day, we know that if people are going to have to, if they have to buy, they're going to buy. If they're going to sell, they're going to sell. My mom, I remember, and Mama, I love you, but I remember I was discussing this with her, and she said, oh my gosh, y'all are so spoiled. When I bought my first house, it was at like 12% interest rate, and y'all are going crazy over 5. And you know, I really kind of had to put myself back in perspective and understand that, you know, it's not horrible. Nothing is horrible right now, and I don't have any really, I don't feel like we're going into this major economic doom. We're not. I'm very optimistic about what's going on, and I'm hoping that we'll get a little bit of a market correction so that buying power doesn't fall.
Right.
And in fact, what my broker Eric and I discussed a couple weeks ago was that because inventory is starting to become so low, and I mean by inventory, I'm talking about homes that are already in the area built. Those foreclosures are pretty much all bought up. The inventory is so low. What are we getting now? We're getting a lot of new builds. So with the new builds coming in, we're having so much development in the area right now. As you can see, they're constantly clearing, they're constantly developing. Is because we're having such a big desire for people to move here. It's beautiful here. It's paradise here. So when you have new builders coming in and they're building a lot of homes, the majority of buyers say to themselves, why am I going to spend the same amount of money on a 20-year-old home that needs a new roof soon, that needs new HVAC, needs updates, all of that? Why am I going to pay market value for that house when I can buy a brand new one? And that, it gives buyers a little bit of an edge over sellers. So sellers have been dominating the market for over the past year and a half. Now, when we start seeing these low inventory with homes and we're getting all these new builds, sellers, I'm sorry, but you're going to be having some competition with these new builders coming in. And, you know, I'm not saying it's not going to be a seller's market. I'm just saying that buyer and that seller market is going to start equaling itself back out again soon. So keep that in mind when you want to sell your home and you're trying to sell it at a competitive price, because it makes perfect sense. I bought a new build. So.
I've lived in a brand new home and I love it. There's nothing like it. It's absolutely gorgeous.
It is. So anyways, just some of the other market updates that we got right now. The S&P 500 was up 0.8% today. Your NASDAQ gained 1.1% today. Trade talks with China, those tensions are easing. So I feel like that has a lot to do with a little bit of the decline that we have. And it also has a lot to do with the Fed holding back a little bit. So to us, that's good. Dollar is down 0.7%. Gas is at $52 a barrel. And with the Fed shift, gold is on the rise. So if you want to make some other investments, gold and silver are a very smart investment to make. If you would like to make if you'd like to know any dealers that are reputable, I can give you some of the contacts that I use. Do you use gold and silver?
I do not personally.
Okay. But real estate and gold and silver is my go-to. Real estate and the stock market is Mark's forte.
Right.
So
it's good to be diversified.
Yes, absolutely. And I'm trying to pick his brain as much as I can as far as the stock market goes, because to me, I just feel like I'm at a big old Texas Hold'em table. I don't know what's going on, really.
So the key to that is just doing research, right? Reading analyst reports, reading Morningstar reports. Again, you just have to take the time to educate yourself, and before you make a decision, call us. We'll be happy to discuss it with you. We're happy to share our information. Again, we're not financial experts, but we do observe the market and we do work in real estate. So.
Yeah, we are realtors that are taking a very close look at the market right now. We're just trying to share some ideas and some information with you guys. Again, leave us a message, or we'll get back to you if you have any questions, or if you have anything to input into our discussion. Please let us know, because this is something I feel like everybody at this time is really interested in and is really...
Should we give it a contact info?
Yes, 850-368-3461 for me.
And I'm 850-830-1703, or you can look me up at whitesandpropertyspecialist.com. I'm Mark Bolts. This is Christy B.
Christy B Real Estate, and we are located here in Harvest Village in Navarre, Unit 61. So you can always come into the office and try to If you want to pick our brain or talk to us, come on over. Oh, hi, Kevin. Is the market in a position that would be good for first-time home buyers right now? Ooh, that's a very good question. Well, I would say that 2 years ago would have been better, but it's better if you do it now than if you wait
Probably true.
for them to hike them. So I'm just being honest with you. Interest rates a couple years ago were in the 3s and the 4s, and now we're looking at 4s and 5s. So if you kind of, over the past couple years, it just keeps going up. So if we don't see a big drop in the Fed, then they're going to keep going up. So I don't trust the Fed. Nobody trusts the Fed.
Well,
But
the thing to remember about the Fed is they're going to try to push the interest rates up back to historically acceptable or normal
6 to 8%
rates.
is what they want. So if they know what their balance sheet is, they've got to get it at what they want, and that is 6 to 8% between that area.
So right now we're still historically low.
So it's better now to buy than wait 2 to 3 years.
That's true. And keep in mind that areas like the Bar and also Pace in Santa Rosa County are growing at an exponential rate. I mean, people are moving in here like, I don't know, I can't quote a number, but it's remarkable the amount of growth that we've experienced in the last several years.
Yes.
And prices will continue to gradually increase. They're not going to skyrocket. Nobody anticipates that at this point, but they will continue to go up. So if you buy now, it's probably a much better time than if you were to wait 6 months or 12 months or longer.
Yes, and if you talk to any of mortgage lenders, things like that, they all know the interest rates are going up. That we all know that. So like I said, it's better now than waiting because it's just going to go up. And if you get in when it's too high, you might not have the buying power that you have now. So that was a great question, Kevin. Thank you for asking that. And another one, if there's a market correction, it would be in part due to the millennial rush we have set in motion. I'm pretty sure that was Rodney. I hear you, Rodney. Millennials, and I'm barely a millennial.
I'm a millennial.
You identify as a millennial.
Simple mind.
Millennials have taken a big hit, and I will say that a lot of my friends have a lot of college debt, and that kind of scares me because we are going from the baby boomers over to us. We're going to be running the economy. Yeah, we are.
Yeah, guys like me are on the way out eventually.
You guys, Mark's on the way out, we're on the way in, and I am a little nervous for people that are so far into debt with student school loan debt that they won't be able to get financed for a home. So if you think that you are in that position, come talk to us that we can help you get a plan. Because if you really want to make it happen, you're gonna have to face the reality that you've got to work with that debt to make it happen. But millennials, yes, we are going to take over the market, and the generation behind us are already, or people that I know, a lot of people that I know, they're not settling for school and a big education. They don't want a 4-year degree anymore. Some of them just want to go vocational. Some of them want to get in where the jobs are. There's nothing wrong with that. That's exactly what we are. I didn't get a 4-year degree. I went to school and got my license, and I've been doing continuing education since. I have to go and take my license, continuing education. I have to renew it constantly. But I didn't pay $40,000 to have my career. I just didn't. And it just makes sense. A lot of those millennials, especially the older generation of millennials, are starting to see that, which I think is good because we're going to need those buyers.
Yes, we are. To
keep the real estate market strong. If you've got too much debt, it's too much student loan debt, you got a car loan, your debt to income ratio. Remember, we set standards. The government set standards after the 2008 crash. Those standards did not go away. Those laws and regulations are still in effect. You cannot have a certain amount of debt and income. You have to meet the ratios. 41% is some, 43% for others, but the debt to income ratio is very vital when it comes to getting approved for a home. So I feel that if we can help buyers get in a position to buy and to work on their credit and to really work on what they've got going on financially, then overall they're going to have more buying power in the end. So,
and the way we do that is we have a lot of preferred partners. I mean, these are highly qualified, highly experienced folks that we work with on a regular basis. And speaking of the education, we take continuing education classes all the time through NABOR and some of the other organizations, real estate organizations nearby. And so we have to be up to date on what's happening in the marketplace and what you as a buyer or as a prospect are looking for, you as a seller, what you're looking for. We have to understand the market. We have to understand a lot about a lot of things, but we're not an expert in anything other than possibly coordinating the overall effort. Kind of like project management. That's
we're an expert in real estate transactions.
Right.
So that's what we went to school for and got our license for. But like I said, we're taking a look at the market. We're observing because it affects our jobs. It really does.
Yeah, it does.
You know, and keeping you guys informed and updated too, you know, that helps us. If you're informed, if we have an informed buyer's market, they're more likely to be able to get approved for home loans.
True.
If I have an informed seller, they're more likely going to be able to sell their home at a fair market value price and get the money and the return and the investment that they put into it versus trying to sell it on their own. So
Good point.
that is a very good point. So overall take is that we feel, and I feel, that the economy is still very strong. We have the jobs are still there. And with jobs still there, that means we have buying power. So sellers, that means you're still able to sell your home.
So last December, for example, just a fact to support what you just said, we created the economy, created over 312,000 jobs in December. That's pretty good.
That is pretty good.
If you look back historically, that's very, very good.
It is very good. And that's what makes me so angry about the Fed. It's like, oh, they're doing good. We got to get them back down. You know, it's like this evil, Darth Vader Lord. Anyways, Star Wars coming up in my mind right now, but
I think the Fed's goal is part of it anyways, to make sure we're close to full employment, and that, well, I'll just leave it at that because I'm not an expert on that either. But they're trying their best to sort of make sure that the economy doesn't slip into recession, stays strong, employment stays near full,
right,
and rates are affordable.
Yeah, rates have to be affordable. Rates are really, really key to us, and that's why I was getting really nervous whenever they were talking about four more hikes in 2019. Because whenever you look at what they already did, 8 hikes in 2 years, if they were going to continue on that trend, I'm getting nervous. I'm just being honest.
Oh, yeah.
You know, and what gets me is why they didn't slowly do it. Why is it such a rush? Why do they have to hike it so fast, so high, so fast? And it's shocking it. It's making everybody just get a little bit nervous. But
it seems like they're under some pressure, backed by Wall Street and others, to actually get back to that historic normal level of probably, I don't know what it is, 8%, 7%.
Well, I mean, yeah. If you have a strong economy, it's between 6.5% to 8%.
Right.
I feel like, and that's what David Collins, my real estate instructor, always told me is that we cannot. It would be horrible for our economy to stay at such low interest rates for so long. We have to grow. We can't stay at stagflation. And these banks and all of that, when they bottomed out in 2019, it was the too big to fail kind of thing. So they all got bailed out, and by our money, taxpayer money, we paid them out. We bailed them out.
Right.
And
the good news is now that the federal government has mandated that they have much higher reserves, so the chance of them going under is far less than it was back in 2008 or 2009.
Right, and those regulations are still in place. Now, I know whenever the economy gets booming like this, there's some of those high-risk loans that are going to be out there. They're going to be starting to become more available. If you don't really know what I'm talking about, what I mean is it's pretty much you can go in and say, yeah, I make $100,000 a year, give me a house, and we'll give you a house. We'll give you a loan for a house.
Subprime mortgages.
Subprime mortgages. We are starting to see a couple of them. I've talked to some lenders saying that, yeah, they're popping back up. So be careful. Whatever kind of loan you get into, come talk to us. Don't do it blindly. Don't just go out to anybody you see on commercial or TV or whatever.
Take the time to get educated. We'll be happy to work with you.
Take the time to get educated. It is your investment. People put so much money into their investments. And with real estate, when it's so good in any kind of market, it makes sense to do the right kind of deal, something that's going to work for you. So overall, economy's still strong. We are up 10% since December to the end of December, Christmas, and so far we're climbing. So with that being said, thank you guys so much for tuning in to Getting Real with Real Estate. Mark, thank you for talking with me.
My pleasure. Happy to talk to all of you. I am a Florida military relocation specialist.
You
I can
did.
help any of the military folks out there. I'd love to work with you. Also, I'm a second home luxury resort specialist.
Yes, Mark lives on the beach, so he knows everything about the beach.
And back to your point earlier about new development, I was just driving around the beach yesterday, handing out my card, talking to people, and boy, there's a lot of new growth out there.
A lot of new growth,
growth.
yes. Last meeting or one of the other meetings before the end of the year, they were talking about we're expected to get almost to 200,000 in San Luis County. That's a lot of growth.
So, yeah, it is.
So anyways, that's pretty much all we got for today. Went a little bit longer, but again, we had a lot to talk about. Thank you guys for tuning in. We hope that you have a wonderful evening and hope everyone had a wonderful Christmas and Happy New Year.
Happy New Year.
Bye, guys. Talk to you soon. And again, if you leave us a message, we will get back to you.
Absolutely. Bye.
Toodles. Yes, and please.